Hi, my name is Christian Walgrave, Head of Research at Teekay, and this is our conventional tanker market update for August 2015. Well, July was another exceptional month for the tanker markets. We saw VLCC rates in the middle of the month as high as $80,000 to $90,000 per day, and they averaged the month at about $60,000 per day, which was the best month for VLCC tanker rates since December 2008. And rates are being supported again by high oil production. We saw record high oil production out of Saudi Arabia, record high oil production out of Iraq, and very strong imports into Asia. China recorded a record high import number of 7.3 million barrels per day in July. And again, this is all being underpinned by low oil prices. So low oil prices mean that refining margins are good, lots of crude moving through the refineries, and also low oil prices mean a lot of stockpiling, particularly, as I said, in China and in India. We also saw some pretty good rates in the mid-sized sectors. Suezmax averaged about $45,000 per day in July, and Aframax is about $35,000. That was down a little bit from June because the June rates on the mid-sized sectors were being supported by some delays, both ullage delays in Singapore and China, and also some weather delays in the Atlantic. Those cleared a bit during July, but we still saw very strong rates, as I said. And really, one of the star performers in July was the LR2 sector as well. We've seen some very strong rates on the LR2s, averaging about $45,000 per day in July. By the end of the month and into early August, we've seen LR2 rates $50,000 to $55,000 per day. And they've really been supported by the ramp up in refinery production from some of the export-oriented refineries in the Middle East, the Yanbu refinery and the Ruwais refinery, and also very high movement of naphtha from the West into Asia. And that's what's given rise to these very strong LR2 rates in the last couple of months. Moving into the early part of August, we have seen the tanker rates soften a little bit on the crude side. In fact, at the time of doing this video, VLCC rates had dropped to about $40,000 a day, and Suez down to about $30,000, and Aframaxes to around the $25,000 to $30,000 per day range. And that's not unusual for this time of year. We are coming towards the time of year now where summer gasoline demand is starting to come to an end, and refineries are starting to think about fall maintenance. So they're going to start reducing their purchasing of crude ahead of maintenance programs in September and October. We're also seeing some negative pressure on tanker rates from weaker refining margins in Asia. So what we've seen just in the last few weeks is that some of those strong refining margins are starting to narrow, probably for a couple of reasons. One is that a lot of crude has been moving to China, like I said, and China's been turning that into products and actually exporting a lot, which means that some of the other refineries in the region have got narrow margins. And that means that we might see some cutback in imports into Asia in the next couple of months. And there has been some stories out in the last day or two as well that Saudi Arabia might be trimming its exports in response to upcoming maintenance and weaker margins in Asia. So we would expect that that would impact on crude tanker rates through August and September, and likely into October as well before that full maintenance is concluded. However, when the refineries go into maintenance, because oil production on a global basis is still very high, that means that more and more oil will end up in inventories. And global oil inventories are already pretty full. So we think that what's going to happen is that as more oil goes into inventories, that will continue to pressure the crude oil price. And we expect that crude prices will continue to drop in the next couple of months. And I think that sets us up for another very strong winter market, because once the refineries come out of maintenance and we're in an environment where oil prices are lower, that will bring the refining margins back, it will encourage more stockpiling, and then you add on to that the normal kind of winter weather delays that we get in November, December, January, February. We think that we'll get a very strong market into the winter months. So our near-term outlook is a couple of weaker months from August through October, and then into a very strong winter tanker market. And we think that the LR2s on the product side will continue to be very strong as well, as I said, supported by some of this extra supply that's coming out of the Middle East. Looking into 2016, we still think that 2016 looks like a good year, particularly in the first half of the year. However, we are starting to note a few macro trends which might impact as we move further into 2016. We've seen today that China has moved to devalue its currency in order to support its exports. And that could just impact a little bit on oil demand into China. It might also put some pressure on other parts of the world to also find ways to devalue their currency and try and encourage exports. And that just increases the risk in terms of the economic environment as we move into 16. And the fleet growth starts to increase to the back half of 2016 as well. We get up to about 4% tanker fleet growth, whereas this year it's going to be more like 2%. So we still see a very good year for 16, but certainly we do see some risks towards the back end. So that's an update on the conventional tanker market, and we'll speak to you again next month.